It was supposed to be just another Thursday, January 15th, 2015. In trading rooms across London, New York, and Hong Kong, the markets hummed as usual. Screens flashed, brokers shouted, and the world's currencies danced in a predictable rhythm. Then, in a single announcement, a single moment, everything changed. Within minutes, billions of dollars vanished, entire trading firms collapsed, and one of the world's most stable currencies became a financial weapon. This is the story of the Swiss franc shock, the day the world learned that even safe money could destroy everything. For decades, Switzerland had built its reputation on stability, a small, landlocked nation surrounded by chaos yet untouched by it. Wars came and went, but the Swiss franc stood strong. Investors loved it. It was a safe haven, a place to hide your money when the world lost its mind. But that reputation came with a price. Every time global markets panicked, money flooded into the Swiss franc, pushing its value higher, making Swiss exports expensive, and hurting the economy. By 2011, things got out of control. Europe was in crisis. Greece was collapsing. Investors were terrified. And the Swiss franc, it soared so high that it threatened to destroy Switzerland's own industries. Factories couldn't sell. Tourism dried up. The currency had become too strong. Something had to be done. Entered the Swiss National Bank, the SNB. On September 6, 2011, they made a bold announcement. They would peg the Swiss franc to the euro. 1 euro would equal at least 1.20 Swiss francs, no less. If the franc ever got stronger, the SNB would step in and print as much money as needed to defend the line. It was a promise, a shield against market panic, and it worked. For over 3 years, the peg held. The franc stayed stable. Businesses breathed again. The markets relaxed. Traders built their strategies on the assumption that the peg would last forever. But forever, in finance, never lasts long. Behind the scenes, the SNB was fighting a losing battle to defend the peg. It had to buy massive amounts of euros, hundreds of billions worth, flooding the world with freshly printed Swiss francs. By 2014, the SNB's balance sheet exploded. They owned nearly as many foreign assets as the country's entire GDP. Every time Europe wobbled, more money flowed into Switzerland. Every time the euro fell, the SNB had to print more francs to maintain the peg. The more they defended the line, the more fragile it became. And then, a new threat emerged: the European Central Bank. In early 2015, the ECB was preparing to unleash a new round of quantitative easing, printing hundreds of billions of euros to save the Eurozone economy. That meant the euro would get weaker, much weaker. And if the euro collapsed in value, the SNB would have to print even more Swiss francs to defend the 1.20 peg. The pressure was unbearable. Economists warned that the peg was unsustainable. Traders whispered rumors that the SNB couldn't hold the line forever. But the SNB stayed silent. No warning, no hints, just calm assurance. Until it wasn't. It was 10:30 a.m. in Zurich. A normal morning. Then, without warning, the Swiss National Bank made a shocking announcement. The SNB has decided to discontinue the minimum exchange rate of 1.20 francs per euro. That was it. No build-up, no leaks, no gradual move. Just one statement. The floor was gone. In seconds, the markets went insane. The euro collapsed against the franc, dropping nearly 30% in minutes. Traders' Fruset charts went vertical. Brokers screamed. Across the world, chaos unfolded. Currency platforms couldn't keep up. Liquidity vanished. Prices flickered wildly. 1.20. 1.1. 1.0. Then 0.85. It was the biggest single-day move in a major currency in modern history. And it caught everyone off guard. The Swiss franc shock wasn't just a market move. It was a mass extinction event for currency traders. Retail trading firms wiped out. Brokers bankrupt. Hedge funds destroyed. In London, Alpera, UK, collapsed within hours. In New Zealand, global brokers NZ shut down completely. In the US, FXCM, one of the largest retail platforms, lost $300 million instantly, forcing a bailout. Even major banks took hits. Deutsche Bank, Barclays, Citigroup all suffered multi-million-dollar losses. And for small traders, it was devastation. Accounts went negative, margins exploded. People owed more money than they even had. In one day, decades of trading strategy vaporized. When the dust settled, the question wasn't just how it happened, but why the SMB did it this way. Why no warning? Why no gradual exit? The SMB's explanation was coldly logical. They claimed the peg was no longer justified, that defending it had become too costly. But for the markets, logic didn't matter. Trust had been shattered. The SNB, once seen as the most predictable central bank in the world, had blindsided everyone. And in finance, trust is everything. Without it, even the strongest currency becomes a weapon of destruction. The shockwave didn't stop in Switzerland. It rippled across the entire financial world. Currency volatility surged. European stocks plunged. Emerging markets trembled. Investors began to fear what was once unthinkable, that any central bank could turn on its promises overnight. The very concept of safe havens was questioned. If Switzerland, symbol of stability, coulait d'eau, who could be trusted? The event became known as the Frankish Dawn, and its lesson was brutally simple. Stability is an illusion. Behind the headlines were human tragedies. Small traders lost life savings. Some lost homes. For many, it wasn't just about the loss, it was about the betrayal of a system they thought was fair. At its core, the Swiss franc shock was a clash between economic theory and human psychology. Central banks are supposed to provide predictability, but when a central bank changes course suddenly, that confidence turns into chaos. The SNB wasn't wrong, economically. They couldn't sustain the peg forever, but the way they ended it without warning created the exact panic they had tried to prevent. Years later, the world faces eerily similar conditions. Central banks under pressure, currencies swinging wildly, markets addicted to easy money and terrified of change. The Swiss franc shock leaves us with 3 crucial lessons. 1. Never trust the illusion of stability. If it looks too calm, it's probably hiding chaos. 2. Levered kills faster than luck saves. The traders who lost everything didn't lose because they were wrong, they lost because they were overexposed. And 3. Central banks are not gods. They're human institutions, political, pressured, and imperfect. When the priorities change, they won't call you first. Somewhere out there, another promise is being stretched to its breaking point, and when it breaks, same story will repeat. Confidence, complacency, collapse. The Swiss franc shock wasn't just a story about traders losing money. It was a warning that control in finance is always an illusion. A reminder that behind every algorithm, every central bank, every currency peg, there's a human hand, ready to pull the plug. Thank you for joining us on this deep dive into financial history. If you found this story compelling, be sure to subscribe and hit that notification bell for more insights that reveal the truth behind the world's greatest financial shocks. We'll see you in the next one.